Your 20s were for figuring things out. Your 30s are where the financial gap between people starts to widen, fast. And most people don't realize which side they're on until it's too late to course correct easily. If you're in your 30s right now, you're probably juggling a lot. Maybe rent's still eating half your paycheck. Maybe you've got student loans that feel like they'll never go away. Maybe you're watching prices stay high on everything from groceries to car insurance, and you're wondering, am I actually making progress or just treading water? That's exactly what this video is about. By the end, you'll have a clear, honest picture of the specific financial milestones that actually matter in your 30s. Not the ones personal finance influencers hype up, but the ones that quietly determine how stable your life looks at 40, 50, and beyond. These aren't aspirational goals. These are the building blocks. And with inflation still squeezing people and economic uncertainty not going anywhere, getting clear on this now genuinely matters. Most people have heard the advice, save 3 to 6 months of expenses. But in your 20s, maybe you had a small starter fund, $1,000, maybe two. That's not enough anymore. In your 30s, your expenses are bigger. You might have a car payment, a lease, dependents, or medical costs that didn't exist 5 years ago. A surprise transmission repair or an ER visit without good coverage can wipe out a thin cushion fast. A real emergency fund in your 30s means 3 to 6 months of your actual monthly expenses, rent, utilities, groceries, minimum debt payments, all of it. Not income, expenses. There's a difference. If that number feels unreachable right now, the goal isn't to save it all at once, it's to treat it like a bill. Automate a fixed amount every single month until you're there. A lot of people in their 30s are contributing something to a 401k or IRA, but they're doing it inconsistently or only when it feels affordable. That approach costs more than people realize. Here's how this generally works. The earlier and more consistently you contribute, the more compounding does the heavy lifting later. Every decade you delay roughly doubles the amount you'd need to save monthly to hit the same retirement target. That's not scare tactics, that's just math. If your employer offers a 401k match and you're not taking the full match, you're leaving part of your compensation on the table. That's the first thing to fix. If you don't have an employer plan, a Roth IRA is worth looking into, especially if your income is lower right now. With a Roth, you contribute money that's already been taxed, and in most cases, it grows and comes out tax-free in retirement. Simple, but valuable. The goal in your 30s isn't to be maxing everything out. It's to make contributions a consistent habit, even if the amount is modest. Credit card debt in your 30s is one of the biggest wealth killers most people aren't treating seriously enough. The average credit card interest rate right now is sitting above 20%. That means carrying a balance month to month is expensive in a way that quietly undoes a lot of financial progress. If you're carrying high-interest debt, it's worth prioritizing that over almost everything else, because no investment you make is reliably going to beat a 20+% guaranteed cost dragging on you every month. Two common approaches people use: the avalanche method, paying off the highest interest rate debt first, or the snowball method, paying off the smallest balance first for psychological momentum. Neither is wrong. The one you'll actually stick to is the right one. This doesn't mean ignoring your emergency fund or stopping retirement contributions entirely. Many people find a balanced approach works. Minimum payments on everything, extra money toward the highest rate debt, and small, consistent retirement contributions running in the background. Your credit score in your 30s starts to matter in bigger, more concrete ways. We're talking mortgage qualification, car loan rates, sometimes even rental applications or job background checks in certain industries. A credit score in the mid-700s or higher generally puts you in a position to access better rates when you need to borrow. The difference between a good and mediocre credit score on a 30-year mortgage can be tens of thousands of dollars over time. The core drivers are pretty straightforward. Pay on time, Keep your credit card balances low relative to your limits. That's called your utilization ratio. And don't open a bunch of new accounts at once. One thing worth knowing, medical debt reporting rules have changed recently. In many cases, medical debt under a certain threshold no longer appears on your credit report the same way it used to. So if old medical debt has been hurting your score, it's worth pulling your free credit report at annualcreditreport.com to see where things actually stand. This one doesn't get talked about enough. A lot of people in their 30s are starting to accumulate real assets, some savings, a growing retirement account, maybe a car that's paid off, and they have zero protection around any of it. If you have people depending on your income, a partner, kids, aging parents, term life insurance is worth understanding. It's generally affordable in your 30s, especially if you're healthy, and it exists to make sure a worst-case scenario doesn't financially devastate the people who rely on you. Disability insurance is another one most people skip. The reality is you're statistically more likely to experience a long-term disability during your working years than to die before retirement. If your income stopped for 6 months, how long would you actually be okay? These aren't fun topics, but protecting your income and your assets is part of a complete financial picture, not optional. Whether you rent or own, your 30s are typically when housing costs hit hardest. Rent in most U.S. cities has climbed significantly, and if you're thinking about buying, home prices and interest rates have made that equation much harder than it was even a few years ago. The milestone here isn't buy a house. That's not right for everyone, and the pressure to own by a certain age isn't financially sound advice. The actual milestone is having clarity on your housing situation, knowing what you can sustainably afford, understanding the real costs of ownership beyond the mortgage payment, and making a conscious decision rather than just defaulting into whatever feels expected. If renting makes sense for your income and life situation, that's a legitimate financial choice. If buying is on the horizon, understanding what you'd need for a down payment, what your debt-to-income ratio looks like, and what additional costs come with ownership, property taxes, maintenance, and insurance, gives you a realistic picture to plan toward. Your 30s aren't about having it all figured out, but they are the decade where the habits and decisions you make start compounding in both directions. Emergency fund, consistent retirement contributions, high-interest debt under control, healthy credit, basic protection, a clear-eyed housing plan. None of these are flashy, none of them go viral, but they're the actual foundation that determines what your financial life looks like in the decades ahead. You don't have to do all of this at once, but you do have to start being intentional, because the people who come out ahead financially usually aren't the ones who made the most money. They're the ones who stopped leaving the important stuff on autopilot. Real stability isn't about reaching some number. It's about understanding how the system works well enough to stop being caught off guard by it. If this gave you some clarity, subscribe to Income Truth. We break down real financial topics without the hype or the noise. Drop a comment below. Which of these milestones are you currently working on? I read every one.